The good news is the Fed is not expecting a recession. What's the bad news? Housing. I think it was 2 weeks ago now, Jerome Powell with the Federal Reserve said that the central bank no longer forecast a nationwide economic downturn, meaning they think we have avoided a recession, which is good for the economy. We're glad to hear that we're not going to be in a recession, but it is still affecting housing. And housing activity will be limited as an impact of tighter policy. They did raise the Fed rate by a quarter point a couple of weeks ago, and mortgage rates are going to be elevated until the actual inflation numbers start to move down to be more consistent with what the Fed thinks they ought to be. High mortgage rates have triggered what we are calling the lock-in effect, because home sellers cannot put their home on the market because they don't want to pay this higher interest rate that they're looking at. And let's say they have a $350,000 house and they're at a 3.5% rate. They're looking to move up. Well, when they're selling their $350,000 house and they're looking to move up, they're going to be at a 6 or 7% rate. They're making a lateral move as far as the payment goes. So they can't truly do that move up house without doubling, maybe even tripling the house payment that they're making. That's what is affecting the housing market right now. About 92% of homeowners have a rate below 6%, and a record 60% of mortgage holders have only lived in their house for 4 years or less. So the higher mortgage rates change that trade-up calculation for existing homeowners and are keeping a lot of move-up or move-down buyers locked in to their current home. So as a result of that, we are expecting home sale numbers to decline this year, meaning the overall number of homes that are sold will be less than in previous years, mainly because we don't have the inventory to sell. Where do you stand on that? Do you feel like you're locked into your house because of the mortgage rate you have? Let me know in the comments.